Okay, so there's a massive gold rush happening in AI right now. It feels like a new startup is launching every single minute. But underneath all that hype, a pretty brutal reality is starting to set in. And it's leading a lot of people to ask, are we about to see an extinction-level event for these new companies? We're going to break down exactly why that might be the case.
It really all kicked off with this bombshell of a Reddit post. I mean, that title alone just sparked a total firestorm of debate between founders, engineers, investors, everyone. So is this whole AI boom just another dot-com bubble that's, destined to crash and burn? It's a pretty provocative claim, but honestly, it's getting harder and harder to just ignore it.
And this is where it gets kind of weird, right? Here's the paradox. While everyone on the internet is predicting doom and gloom, venture capitalists are just writing checks like there's no tomorrow. We're talking about nearly $150 billion poured into AI startups in just 9 months. So you've got this grim prediction on one hand and a literal mountain of cash on the other. Something's got to give.
So what's at the heart of this big extinction event thesis? Well, it's pretty simple. Most of these new startups aren't actually building their own foundational tech. They're just putting a slick new interface on top of a powerful model that's owned by OpenAI or Google or Anthropic. And that forces a really tough question. Why would a customer pay you for a service when ChatGPT can probably do it better and for less money? This is the central threat that thousands of companies are facing right this second.
Look, this isn't just some theory. It is playing out in real time, and it's happening through a few common and, frankly, fatal business patterns. Let's break down the traps that are turning the AI dream into a total nightmare for so many founders out there. The very first pattern has this great name, wrapper syndrome. This is when your entire business is basically just a thin layer, a wrapper, around a big tech company's API. You're really just reselling their technology with a markup, and that is not a defensible business. You have no real competitive moat. If the API provider, say OpenAI, decides to offer your feature themselves or even just changes their pricing, your company could literally evaporate overnight.
And that leads us right into a related problem, building a feature instead of a real product. So an AI that transcribes your meetings, that's a cool feature, for sure. But here's the thing. Giants like Zoom and Google Meet can just add that feature natively, and poof, dozens of startups are gone, just like that. A real product, on the other hand, solves an entire workflow. It doesn't just transcribe, it plugs into your CRM, it assigns tasks, it tracks progress. It becomes so deeply embedded in a business that it's basically indispensable.
And finally, we get to the brutal math of it all. The cost of just running the AI for each user, that's a process called inference, can be incredibly expensive. Then you add in cloud costs, the rising price of finding customers in a crowded market, and you get this deadly downward spiral. For a lot of these startups, every single new user they sign up actually loses them money. I mean, that's a business model that's fundamentally broken right from the start.
But hey, this isn't all just doom and gloom. While the old playbook is basically obsolete, a brand new one is starting to emerge. The survivors, that 1%, they're not playing the same game as everyone else. They get that the old ways of building a competitive advantage just don't apply anymore.
For the last decade, the big mantra was data is the new oil. The company with the biggest, most exclusive data set was supposed to win. Well, that era, it's over. These new foundation models, trained on pretty much the entire internet, have democratized access to information. Now, the new advantage isn't about hoarding data. It's all about the speed at which you can apply insights and just execute.
So this new focus on speed breaks down into 4 key advantages. First up, pure execution velocity, just shipping new features faster than anyone else. Second, AI-human integration. This is about making people better and faster at their jobs, not replacing them. Third is compound intelligence, which is where you creatively combine multiple AI tools into a workflow that's really hard for anyone else to copy. And finally, number 4, vertical specialization, becoming the absolute best solution for one specific industry, whether it's law or medicine or something else.
And this quote from a doctor on Reddit, it's a perfect example of what works. This AI tool isn't for everybody. It's vertically specialized, just for medicine. And it's not trying to replace the doctor. It's integrating into their workflow to handle all the painful documentation, creating that essential AI human loop. They're solving a deep, painful problem in a very specific niche. And what's the result? The customer says they will never go back. Now that is a real moat.
So how are these companies actually making money? Well, this chart shows that it is all over the place. There's no single right answer yet. About a third of companies are just bundling AI in for free, hoping to win on volume. Others are charging a premium. And look at this, 11% are just still trying to figure it out.
That's a huge sign of just how early we still are in this whole market's evolution.
Okay, so when you combine a super high failure rate, a brand new set of rules for survival, and total uncertainty around how to even make money, you start to see the inevitable outcome. The future here isn't a simple story of success or failure. It's a massive reshaping of the market, what we can call the Great Consolidation.
And if trying to compete with tech giants and finding a working business model wasn't already hard enough, there's another almost invisible barrier that gives the big guys a massive, and you could say unfair, advantage. It's called the compliance trap.
Yeah, this data right here is a total gut punch. A sudden 200% jump in compliance costs, maybe from a new regulation, can be an extinction-level event for a startup. It can turn a healthy 13% profit margin into a 7% loss. Suddenly they're underwater. But for a tech giant, their margin barely moves, just dropping from 22% to 20%. They can absorb that cost without even breaking a sweat.
And the problem is actually deeper than just that one cost. For the big tech companies, compliance is a standardized, predictable process. But for startups, as you can see here, it's just chaos. They have no standard way to budget for it, which leads to these massive overruns. For example, one autonomous driving startup found its compliance costs were, on average, 2.3 times higher than its actual R&D costs. That's a hidden barrier that's practically designed to kill small players.
So this all leads to one pretty inevitable conclusion: consolidation. Most of these startups will either fail or they'll get acquired by the big players who want their technology and their talent. But it's really important to remember, for a lot of founders, getting acquired is the win. This isn't necessarily a bubble bursting, it's just a natural, if pretty brutal, phase of a new market finding its shape.
And this consolidation is all happening for one simple reason. The stakes are just astronomically high. We're not talking about $1 billion market here. Analysts are predicting that this next wave of AI will be worth over $3 trillion. With a prize that big, the market naturally starts to concentrate power among the very few players with the resources to actually compete.
Which leaves us with one final and, I think, critical question. In a world where powerful AI technology is basically becoming a commodity, what really sets the winners apart? Is it having the absolute best, most cutting-edge technology? Or is it simply the ability to execute, to integrate, and to adapt faster than everyone else? Thanks for joining this explainer.